In 1980, putting your savings in a basic bank account paid 12% interest. In 2026, the same account pays 0.4%. Same bank, same product, completely different financial reality. And the difference has nothing to do with you being lazy. Nothing to do with you spending too much on coffee, and nothing to do with banks getting greedy. It has everything to do with a structural redesign. That happened quietly, starting in 1971. A redesign nobody officially announced, and almost nobody has explained clearly until now. Your grandparents built modest middle-class wealth using the most boring strategy imaginable. They worked, they saved, they let compound interest do the work. Today, that exact same strategy makes you slowly poorer every single year. Not because the math of compound interest changed, but because the dollar that gets compounded changed. And once you understand what actually happened to the dollar, you'll never look at your savings account the same way again. So it is time to learn how money works, to find out why doing exactly what your parents did now leads to the exact opposite financial outcome. Okay, so the first thing to understand is that your parents and grandparents were saving a fundamentally different currency. Until 1971, the United States dollar was anchored to gold. You could not print more dollars without backing them with something real. That meant the supply of money grew slowly, roughly in line with the actual productive economy. In August 1971, that anchor was cut. The dollar became what economists politely call a fiat currency, which is just a polished way of saying the only thing keeping it valuable is everyone agreeing to pretend it is. From that point forward, the supply of dollars in circulation could grow at whatever rate the Federal Reserve decided. And the Federal Reserve has decided, on average, to expand it by about 7% per year, which means in any given decade, the total stock of dollars roughly doubles. Your savings account does not double in any given decade. This is the silent tax that nobody talks about. Because admitting it exists would force admitting the system isn't really fair. Which brings us to problem number 2. For most of the 20th century, savings accounts paid interest rates that were higher than inflation. That meant if you put $1,000 in the bank for 10 years, you came out with more purchasing power than you started with. This wasn't an accident. It was the entire point of saving. Today, the average savings account pays around 0.4%. Inflation, even by the friendliest official measure, runs around 3%. The math is brutal. Every year you hold dollars in a standard savings account, you are guaranteed to lose roughly 2.6% of your purchasing power. Now, to be fair, high-yield savings accounts and treasury bills can sometimes match or barely beat inflation. But that is not really beating inflation. That is just running fast enough not to lose ground. Compare that to your grandparents, who could put money in the most basic account at the corner bank and reliably outpace the cost of living for decades. That world doesn't exist anymore, and it wasn't taken away by accident. And this brings us to the third problem, and it is the one nobody at any bank will ever say out loud. When you deposit money in a savings account, the bank does not simply hold it for you. The bank loans your money out to other people, typically people buying homes, businesses, or assets. The bank charges those borrowers interest at one rate and pays you interest at a much, much lower rate. The difference is the bank's profit. But here is the part that gets uncomfortable. The borrowers, using your deposited money, are usually buying assets that appreciate faster than your wages. So while you are earning 0.4% on your savings, they are earning 8 to 10% on the assets they bought with your savings. You are, in a very real sense, financing the asset purchases of people who are already wealthier than you. And when those assets appreciate, the gap between you and them widens. This is not a conspiracy. It is just how fractional reserve banking works. But it is also why putting money in the bank no longer builds wealth the way it used to. You are not really saving. You are providing cheap capital to people climbing the asset ladder you can't afford to step on. Now here's the part nobody really wants to say out loud. The Federal Reserve has an explicit policy target of 2% inflation per year. That is not a side effect. That is the goal. What that means in plain English is, the central bank is officially committed to making your dollar worth 2% less every year, on purpose, because they have decided that mild, persistent inflation is good for the economy, even if it is structurally bad for anyone trying to save in cash. The official reasoning is that mild inflation encourages spending and investment, and discourages hoarding cash, and the official reasoning is technically correct. But the unofficial reality is that this policy quietly transfers wealth from savers to borrowers, from wage earners to asset holders, and from the patient to the leveraged, every year, like clockwork, by design. So when your parents tell you to save more, they are not lying, they are just operating on outdated information. Their advice was correct in a world where dollars were anchored to gold, and savings accounts paid more than inflation. That world ended in 1971. The advice never got updated. The harder you work to save dollars, the more value those dollars quietly leak out the back, and the more you fall behind anyone who converted their dollars into something that grows with the money supply instead of against it. That is not a personal failing. That is just the math of a currency that was redesigned without telling anyone. If you want to understand exactly where those dollars go after they leave your savings, go and watch this video next. And don't forget to like and subscribe to keep on learning how money works.